Hi, I'm Michael Pitts, Vice President and Director of Tax Strategy for Old National Wealth Management. Last week, the Conference Committee agreed on a tax bill that is expected to be voted on by the House and Senate this week. While there are no guarantees, the conference version is expected to be passed by the House and Senate and signed by the President. Under the conference version, the standard deduction is raised significantly, $24,000 for married couples, and many itemized deductions are eliminated or reduced beginning in 2018. For this reason, there are a few things you may want to consider prior to the end of 2017. First is state and local taxes. Beginning in 2018, individuals can deduct up to $10,000 of state and local income or sales taxes and state and local property taxes. Due to this limitation and the larger standard deduction in 2018, individuals who are not in AMT should consider paying fourth quarter estimated taxes as well as any tax due for 2017 prior to the end of the year. Note there is no benefit to prepaying 2018 income taxes as the bill specifically disallows a 2017 deduction for such payments. Next up is the mortgage interest deduction. Beginning in 2018, individuals may only deduct interest on new mortgages up to $750,000. They can still deduct interest on larger mortgages that are already in place. Also, the deduction for home equity interest is eliminated beginning in 2018. Due to the new limitations and the larger standard deduction in 2018, individuals may want to consider prepaying their January 2018 mortgage payment. Miscellaneous itemized deductions are eliminated beginning in 2018. Individuals who are not in AMT may consider paying the following expenses before year end: unreimbursed employee expenses, tax preparation fees, expenses incurred to produce or collect taxable income, expenses incurred to manage property held for producing income, and expenses incurred in paying any tax. Another thing to consider is charitable contributions. As we've been discussing, many taxpayers who itemize in 2017 will use the standard deduction beginning in 2018. Those who continue to itemize will likely have a lower marginal tax rate. To maximize your deduction with respect to charitable giving, you may consider making next year's charitable contributions during 2017. Something we discussed last time was basis determination on the sale of securities. The Senate bill at one time included a provision that would have required taxpayers who sold securities to use a first-in, first-out method to determine capital gain or loss. This provision is no longer included in the final bill, so this is no longer a concern. Finally, the conference bill has a provision related to IRA recharacterizations. 2017 will be the final year that individuals can unwind a Roth conversion by recharacterizing back to a traditional IRA. However, taxpayers will still be able to recharacterize contributions from a traditional IRA to a Roth IRA and vice versa. As of this taping, the bill has not been passed, so there is still some uncertainty. And as always, we encourage you to talk with your tax advisor about your specific situation.